Hello, let's try and understand what is risk management. But before we do that, let's first try and define what is risk. Risk is the possibility of a loss, and this is owing to an uncertainty. What is important is the uncertainty of it. Any certain event is not a risk unless there is an element of uncertainty in it. Let's try and understand the various types of risks. What we have here are risks like a market risk, a credit risk, operational risk, investment and regulatory risk, and finally a settlement or a liquidity risk. Let's try and understand each of these in detail. Let's start off with market risk. Market risk is a financial loss owing to changes in the prices. Let's say you buy a commodity for $100 and the price dips to $95. The loss of $5 is owing to the changes in price, and hence this is your market risk. Not just the change in price, but there are other factors as well which result into a market risk. We can probably categorize as a direct risk or an indirect risk. The direct risk is due to factors like the change in business or the balance sheet or capital, resulting into the value of that particular underlying changing. Indirect is dependent on various other factors which indirectly impact and create market risk. Things like changes in interest rate levels or economic events or any political or any other environmental risks. While generally market risk is always about the changes in prices and the loss owing to that, but we must also understand that market risk is about not just the volatility of a product, but let's say changes in currency movements or interest rates or commodity prices and the performance of equity as a whole. The other type of risk is a credit risk. As the word suggests, this is a risk if a simple loan is not repaid. If I take a loan and do not repay it, or there is a possibility that I may not repay it, that is a credit risk for the one who's lent the money to me. The goal is to maximize a firm's risk management against credit risk. We can also look at credit risk in two different ways. One is the counterparty risk and the other one is the issuer risk. A counterparty is someone whom you've dealt as far as a loan is concerned. Here, if the risk is about non-payment of any obligation that are a part of this particular debt security. Issuer is the one who borrows. Any risk as far as issuer not being able to fulfill or perform the obligations related to that particular loan is an issuer risk. Let's talk about operational risk. The risk of a loss arising out of a failed internal process or a system or a human error is nothing but an operational risk. Operational risk is about people, systems, and processes, and hence the risk management techniques continually evolve around mitigating this risk. Developing robust systems and processes, putting controls that will lead to a staff not making mistakes, training the staff are some of the ways to mitigate operational risk.